Welcome to the webinar. You have entered as an organizer and may now speak to any other organizers or panelists on the line. When you are ready to begin the presentation, press the Start Broadcast button on the GoToWebinar control panel to allow all attendees to hear you. This system will notify you once you begin your broadcast. The broadcast is now starting. All attendees are in listen-only mode.
Good evening, everyone. Welcome to Admiral Markets. Sorry for all those messages. I'm not sure if you heard the software, all those messages from the software. But in any case, thanks for joining. And we're going to take a look at trading logic and plans based on timing. That's the topic of today on the 28th of January. And Nanette and I will be going through that together. First of all, though, be aware that this webinar is shown to a global audience, but may not be suitable for everyone. Please take a look at the link, select your country of residence, and contact the appropriate entity to find out more information about that. Also, please be aware that trading for exchange and global financial markets is considered high risk, may not be suitable for everyone. Please seek the advice of an independent financial advisor for more information on that. This webinar is not advice and is for informational and educational purposes only. And by continuing watching this webinar, you agree with this disclaimer, plus you're aware of the risk involved when trading. All right, thank you so much. Admiral Markets has a lot of things going on. WebTrader has been recently released and announced, and you can use that to trade from the browser, in fact, not needing any software to download or to use, and just going to an internet browser and logging in and seeing charts is a very neat addition to the Supreme Edition, of course, that already existed for the MT4 with a lot of extras there. And so that's one of the things, IT very much in the focus with Admiral Markets, but also analysis and content. And, you know, that's probably one of the reasons why we got nominated as well by the AM UK Awards last year and FX Street. So let's see how the latter one shapes out. Thank you for all the votes that that you have done. We really appreciate that. And now, for today's topic, we're going to take a look at the importance of timing. How can we use it? Why should we use it? And all this good stuff. Now, for those that join perhaps some of my webinars in the morning on Tuesday and Wednesday with live trading, you probably have heard me talk about it before. But we're going to start from the start. Why is it important, and for which traders? Well, first of all, timing is really something of a concept that could be definitely used, of course, if you're trading candles, bars, and line charts, for instance. Anything that has a time element, a time dynamic or dimension, I should say, in axis. But if you're not using that and you're using range or Renko or point of figure, anything that does not have a time, right? Anything that shows a bar or a candle, not based on time, but based on volatility or price movement, well, then it's not going to have any importance. So why would it be important? Why is timing important? With timing, of course, the term timing could be meant in various ways. We could be looking at timing from a session point of view. Is it good to trade the pound USD during the Asian session? That could be a timing part. Not going to talk about that, but that could be one way of interpreting timing, or time frames, right? We talked about time frames in the past. That's one thing of timing as well. How much time do you have to trade, for instance, right? But also just the timing of an entry and stuff like that. So basically, one of the first reasons I think timing is important is because we have two dimensions. We have two sides. We have price and time. So we see a lot of traders focusing on price, but not many traders really thinking about the time factor at all, right? If there is a few, then it's really a small minority. And obviously, price action is in a way also a bit of a relationship between price and time, right? But it's really a big focus on price levels, price this, price that, price action, price candles, and not much talking about timing. I mean, if you look at the books that are available, I was not able to find any books on timing in Forex. I did find one in timing in stocks. And if you ever find a book on timing in Forex, please let me know. I'd love to read it. I haven't found it. But it's interesting to me, kind of strange to me as well. We got two sides of the graph, but we're only using one. of the two. The other important part is leverage. Okay, there's a lot of, especially in Forex, traders are using leverage. So it's not only about the price, but also about when we enter. Euro dollar long could be or short could be a great idea for a trade 2 weeks from now or 2 weeks ago. But if it's not now, if it's not a good idea now, then it could be a loss, especially if you're using relatively tighter stop losses. The market makes a lot of dips ups and down, and then in that case, if the timing is incorrect, then the market might go against us and take out our stop loss. So especially if the market if there's no leverage used at all, then we have a bit more time and patience, even if it takes a month. Eventually the trade might go our way. As long as we trade with the trend, there's a good chance of price making that continuation sometime in the future. So the timing is less important. Now, from a psychology point of view, very important that we enter a moment that we're not running into a large correction. If price is going sideways forever and ever, and days and days and days and days and days, we're in a trade that we see prices up our way 10 pips and then down against us 20, and then it's going our way 50, but then it's going against us 60. It's psychologically very tiring. Other things, if the trade is shorter, if we're in the trade for an hour, there's less risk on board and we're missing less opportunities. If we have our capital stuck in a trade that is in a corrective triangle for 1 week and we can't take any trades anymore because we're at our risk management max, and if we take any trades after that, we're breaking our rules. So we can't do that, but we're stuck in that trade, so we miss opportunities. Simple. We're in that trade, and if it ends up in a loss, we were not able to trade anymore that week or month. And if it ends up a win, fine, but we got one win instead of maybe the opportunities we missed as well. The shorter the trade, the less risk, the better for psychology, and less chance of missing opportunities that could be good. Another important aspect of timing is I already talked about it just slightly, is about the time that we have to monitor setups. It's a dynamic of time that's a bit different than the charts. Of course, I was talking about time on the chart, but obviously important. If we have an hour of trading time and after that we cannot manage the trade, well, we could either scalp or take a swing trade, so that when we do have time 12 hours from now to take a look, we have time to manage that trade. Obviously, if we trade, we need to find a match there between our availability of managing and evaluating and monitoring and the time we have. And the strategy, I mean. All right, time frames and market moves during the week. That's also connected to timing. So we traders tend to like to focus on entries, maybe a bit on exits, but don't think about how long a trade really takes. When we're back testing or forward testing, or we're demo testing, or we're using a EA to back test, we don't look often at, okay, I enter here and I exit here. Fine, that was plus 50 pips profit. But we don't look at, okay, how long did that trade take? If I'm trading on an hourly chart, oh, wow, it took 48 bars for that trade to get to my target. If we don't have that information, it's dangerous because we look at the past and say, okay, that was a win. But we don't think about how long we psychologically would have to stay in that trade. It's easy to backtest and look at the trade and say, oh, wow, look, it went pretty fast to my target, but it still took 30 bars. 31-hour bars is still 30 hours. And if you don't realize that, if you don't put that on paper and really plan for that beforehand, you're not mentally prepared most of the time to hang in that trade for 30 hours. And after 5 hours, you may think, oh, boy, this is taking long. I thought it would be a win. It's not a win by now. And you close the trade too soon, as the average time could be another 25 hours. But if you're not aware of that, then you might take trade management decisions that are basically out of psychological fear factor, not ready for waiting that long for a trade to develop. And if we have that data, then we're prepared and we know that it might take a bit of a time before a trade goes our way, and we'll have patience um, to a certain moment. And we also know when to stop being patient. That's another side of things. If we know that the max length of trade for a win is going to be 50 bars. After that, the number of wins decrease, or you see less wins as just a absolute number. Well, you might want to be careful after that 50 and really seriously think about trade managing that and trail stopping that. So it gives us info about being patient at the start, perhaps, and being less patient at the end, finding that balance. And I talked about trade management, I think that was last week, right? Or no, that was Fibonacci, 2 weeks ago. And about how I'm patient at the beginning and less patient as the trade develops. Well, having data like that helps when configuring those moments. So that's something everyone can do themselves. Go with your strategy, go to the past and do some testing, write those data down, and you'll get some idea, or look at the stats you have as well. So in general, though, and then I'll dive into more details, but this is just a very rough rule of thumb here. But I'm looking at breakout trades, and I'm pretty demanding for those breakout trades. I would like to see those trades go pretty fast into my direction. I want to see those trades move into a positive territory relatively fast. It's not like it has to be the first bar, it's now or never, but I would like to see a bit of pace into that. It's fine if it breaks, retraces, and then continues, or if it breaks and continues right away with an impulse, even better. But beyond that, I'm not going to give it more time, because if it does take too long, it could easily turn out to be a false break. If I compare that then again to bounce trades, where price is hitting a trend line, or hitting a fib, or hitting that head and shoulders pattern you see in this chart right here, right? We're actually talking about it on Monday and Tuesday, right? The head and shoulders pattern, inverted head and shoulders pattern. That is a bouncing spot, right? That could be a bouncing spot, we said. And well, those trades can take a bit longer. Well, in this case, it didn't. It was pretty fast, but those bounces can take some time. When price reaches a fib, it doesn't always turn on a dime. No, there are actually a lot of cases where price takes its time for a bit of before it turns and goes back to the other direction. All right. So a bit more information about how I actually use timing as an entry and an exit, and when I use it. So when we look at the momentum and correction, looking at basically timing or momentum and let's say the lows and the highs, it's getting a bit more um, melted together, all right? Because if you look at momentum, it's basically an impulsive, quick price action that just flows in one direction. What you'll see is price having bigger bars into that direction. Here we got a bearish example, so we got big candles to the downside relatively. We have candles that close near the low, and the majority of the candles are going to be bearish. Those are three characteristics that are important for impulse. When I consider an impulse to be finished, right, is if we don't get a lower low or a higher high within the last 6 candles. So if 6 candles fail to post a lower low or a higher high, then we're going to get into a point that momentum I consider finished. And we're in a corrective consolidation zone. Doesn't mean that price will not continue after that correction into the same direction. Here in this chart, we had momentum, consolidation zone, and then again indeed later, one more downside momentum. But it took a decent amount of time before we got the follow through. So if you can recognize if price is in a momentum or in a correction and how far it is roughly in that correction, then we have a better idea about how long we have to stay in the trade. For instance, let's say I took this pin bar reversal just for hypothetical fun, all right? And I'm in this short, and I see 6 candles not breaking that low anymore. 1, 2, 3, 4, 5, 6, and there's a doji right there. I have two choices. I could take my profit because I know that the momentum's over, or I could estimate that there's a high chance that after the correction, price could still go lower, and I'll be willing to take the risk of staying in the trade, but knowing that there's going to take some time before that trade continues. The fact that I know that would mean that I'm patient with this consolidation, and I'm not expecting too much in the next, 7 to 10 bars, at least. The fact that I'm not expecting too much within that time frame means that I have patience for that length. If I don't know about that, I could be making mistakes. I could be exiting too soon here in the momentum. Unless you really like that, could be a reason for you to take P there. By the way, take profit. There could be confluence of support, then that's fine, right? But let's say I use trail stops instead, all right? Or you use a mix of TPs and trails. But if you use momentum as a guideline, that would be too soon, okay? And maybe I would be too soon in exiting somewhere in here because I think, oh, it's really not going my way, right? And then it really finally starts going my way just a bit later. So with time in mind, we can either exit at the right spot or hang in for the next move. So correction is basically when we have 6 candles not breaking that, right? So it's a corrective, basically slow price action. Price is going sideways. Most of the time we have a mix of candles. The closes are really not in the middle. They're not near the high or low. Sometimes yes, but it's just coincidence. We got a lot of wicks, and it's all a bit of a mishmash in mix. That's correction. So momentum and correction is a combination, obviously, of price and time. But by using price, we would know when momentum could stop. Obviously, if we identify a very strong level, a very strong support level where price has multiple things, a fib, a horizontal daily level, etc. Well, then, yeah, on the hourly chart, there's a good chance that price could fall to that level and stop because it's a strong confluence. Momentum could easily stop there, right? That's price side. But the momentum can also, we can also measure if the momentum is stopping by keeping an eye on time and saying, okay, if 6 candles do not break it, then the chance of that momentum going into correction is high. That's time kind of aspect, all right? All right. So that also helps with breakouts and bounces, this information, and that's what I'm going to dive into now. But first, one more slide, sorry. There's actually one thing that I want to add. Basically, these numbers, I've talked about 5 at the moment, 6 actually, but small swings are considered to be 5 candles. So basically, when price is pushing and keeps pushing in this momentum here on the left, okay, price keeps pushing, right? We got within 5 candles, we got candle high, boom, candle high, failure to break, 1, 2, 3, 4, but the 5th breaks, a candle high, got a candle high. So this is momentum. This is a push of momentum. So small swings are 5 candles. So basically, as soon as 5 candles do not break a top, we got a small swing. Now I use 6, but a lot of people refer to 5 because of the fib numbers, 5 and 13. So when we have 5 candles not breaking this top, and that happens around here, we can consider that this is a small swing. Larger swings are a group of 13 candles or more. So once we get 13 candles here, this could be considered larger swings. All right, so if we have a swing, 5 candles in the swing, those are 3 small swings. And then if we get a period of 13 candles, then they together make a large swing. So the green is 3 small swings, and the blue circles is 1 large swing. So 13 candles is what I expect once the correction starts Once again, when 5 or 6 candles do not break the momentum, high or low, we are in a correction. But how long can the correction last? On average, according to what I've seen, it will last at least up to 13 candles. And there are definitely exceptions, especially on the yen, when we get a candle break on the 10th candle. It's not perfect. But statistically, as far as I've seen from my experience and from testing, 13 or higher is the level where price typically tends to continue or break or make a breakout. So once we've reached 6 candles and not continued with the momentum, the correction typically will last another 7 at minimum, if not more. All right, and if there's any question, oh, there is a question here. Let me know. What forex pair is this and what time frame? This is, in my opinion, universal rules. So it's actually, I've looked at DAX as well. Interesting enough, it didn't look to be that bad. You know, didn't seem to be working okay-ish on even a stock index, but with a big if, but with a big but, because I didn't really do a lot of testing. But you know, this is definitely for forex something I've seen on all time frames on all currency pairs. Something that basically it's kind of like a DNA of the charts, right? You see chart patterns, you see on all time frames, on all currency pairs, on all instruments, in fact. They're everywhere, right? Patterns, candlestick patterns, chart patterns, you see it everywhere. So from that point of view, I myself at least consider these things to be the same on the same level. What is T89? I'm not sure what T89 is. Not sure. Is that a moving average, or I'm not sure what you're referring to. So when we're looking at, let me know, okay? When we're looking at the momentum, to have a breakout, to have some momentum is important. And this is something that is not easy sometimes to quantify. What is momentum exactly, right? There's definitely some discretion there. What you consider momentum, I might not, and what I consider momentum, you might not. But what I try to use as a bit of a rule is at least see 3 bars going into one direction with decent sizes within a group of 6. That's basically the definition I've been using at the minimum. At the very maximum, sorry. So, I mean, if we see 3 out of 4, that's great. 3 out of 5, great. 3 out of 6, great. Oh, good. But then 3 out of 7, well, yeah, that's just an arbitrary border, but to give you a rough idea. So on the left side, I see 3 bars in one direction. So that's momentum. That's the minimum momentum. Obviously, sometimes momentum lasts a lot longer and it keeps pushing a lot further. But we need to have momentum, I think, for a breakout trade. Either, in this case, for a breakout trade on this time frame, it's an hourly chart. So I can see momentum here and I see a correction. So if price breaks below the correction, there could be another momentum, right? That's one way of doing it. Momentum, correction, momentum, or break. That could be a breakout entry. But it's also one other way is possible. This is 1 hour time frame, right? So I could wait for a break of this, or I could even basically look for momentum on one time frame. And if the momentum is still pushing on that time frame, if we had a recent lower low, I could even zoom in to lower time frames, 5, 15-minute chart, and look for pullbacks on that 5 or 15-minute chart, or look for breakouts, because I want to trade the continuation of that momentum. So there are 2 ways of trading it. One is the current momentum as it's going, but then have to look at lower time frames to kind of look for that smaller pullback, or let that momentum finish, look for a correction, look for the continuation. One is within the first or the third within that red arrow. The other one is trading larger parts of that red arrow. So it's good to have momentum on your side with the breakout, because that is the thing that pushes price quickly into our direction. And the exit is one of the better exits on average, and sometimes, yes, price does reverse quickly to the other side, something you want to also be aware of. Sometimes, yes, it does do this. We got a ABC three-wave correction, and all of a sudden price hits support and starts to do this. And if you wait for 6 candles not to break this bottom here at the green, price could be already far to the other side. That is a bit of risk. Sometimes happens, yes. But there is, and I don't have any percentages on this, unfortunately, but there is I think, definitely majority, if not a substantial, yeah, edge there, or not edge, but bigger likelihood, right, that the first 6 candles will, there could be a bit of upside, but then there'll be still a hook back before you get a bigger continuation to the other side. All right. Like, for instance, in this example here, no, where is it? This one. 6 candles, you're about here, and you're just a few pips off that low. Well, that's a great exit. All right. So once the momentum is gone, 6 candles have not pushed our way, well then probably that could be a good time to exit. We could still survive, and we could still stay in that correction, try to survive that correction for the next continuation, if there's a lot of confidence that that will happen, if there's a lot of clues that price is just pausing temporarily for a couple of hours before continuing. All right, so that's something that you want to keep an eye on, the fading of momentum. All right, let me see some questions here. T89 is a pin bar on the 80. I love pin bars. I love price reactions on moving averages as well. Although I personally don't use the 89 EMA, but I use 144 and 21. But I think that all EMAs are great, and all of them work pretty well. So I see no reason why an 89 is just as good. I just, by coincidence, use different ones. Is there any recommendations when a trade is better off? When to enter a trade after economic news release, because real move sometimes starts after a while when news are being released. Well, generally speaking, the minimum you want to wait 10 minutes. Anywhere, if you want to be more conservative, 30 minutes before you take trades. You want to see the volatility die down and know that the news event is out of the way. So from that point of view, you want to give it 15, 30 minutes before that happens. All right. So that's breakouts. For instance, here a breakout. This is a breakout right here. Let me show you. This trend line, price breaks out and keeps pushing our way quickly, right away into positive territory on this perhaps hourly chart. And the hourly candles, look at that. They keep, most of them, except one or two, keep posting a higher high. That's exactly what we want to see with the breakout. Beautiful momentum. Then once 6 candles do not break, what happens? Okay, so let's count. Well, if we can, let's see, 3, 4, somewhere in here, the 6th candle doesn't post a newer high. That means momentum is over, and you can see that that worked pretty well. Look at that momentum here, and you catch most of the momentum without guessing where price would necessarily end, although the minus 61.8 target was pretty accurate. And that was a perfect exit of the breakout. Now, bounce entry is a bit different. Here, we want to see price lose its momentum. So, for instance, if momentum was falling like this, and I was looking for a long because the trend is up, I could use the opposite logic. I could say, okay, the momentum is down. I have time. I'm going to wait 6 bars until price doesn't break the low. Once that happens, 6 bars. So let's take a look. 1, 2, 3, 4, 5, somewhere in here, right? Momentum is to the downside is over. I could take a entry right there, or I could not necessarily enter right there, but I could wait for a fractal break, for instance, or I could place the first fib from fractal to fractal and look for the dip here, or the continuation break. There are a lot of entry options as well. But the sixth candle itself could be it. Could be the entry right there. And we get the momentum change, right? Sorry about that. We get the upside as we expected because of our analysis. Let's say that the trend is up and that this was a correction. And if we're looking to take profit, well, six candles again, somewhere in here. And the same thing could be for a bounce at the 61.8 fib, right? If we see prices reaching the 61.8 fib or the 50 fib, right? Somewhere along in here could be one. Now, that didn't go too far, right? So that's something you want to be aware of as well, that sometimes we don't get a big bounce. The 50 fib was not the bouncing spot, but a lower fib. So that could lead to some risk on the table at any time, of course, right? So you might want to trail stop it, for instance. Or if you see the first bearish engulfing twins, could be a reason to exit. Some trade management could help in this case. If we're looking for the bounce at the 61.8 fib, it could be here or somewhere in here. Right? Those are moments where price has stopped going to the downside. And when do we want to exit the bounce trade? Basically, the bounce entry, Nath, is basically when the other side, the other momentum has finished. So here we see there was a bit of momentum here, in fact, wasn't there? Although smaller than the upside, but there was a bit of momentum. So once six candles don't break this low, that could be a bouncing spot. Or when six candles do not break the second low, the second green arrow, that could be a bouncing spot, right? The bounce exit, basically, if we don't see momentum going our way. So back to this example here, this could be a tough one. I'm not saying it's not. Sometimes you take a bounce trade and price goes up 20 pips, not so much, whatever it is, and then continues to the opposite direction, and it's tough luck. It's a loss, a full loss. Definitely happens, right? In other cases, we are able to monitor it and be able to see that the momentum is not there. For instance, this engulfing twin perhaps could be one signal, right? And we're like, okay, the momentum is not really as much as I wanted to. I'm out, or I'm trail stopping. That's one way. There's no momentum. Or the end of momentum. Let's say I took a bounce trade in here, and I got the momentum. So here the momentum ends. That would be another moment of exit for the bounce. Now, in general, stop losses and timing, I think, have a very strong relationship. Because when you, let me, you know what? Let me make this chart just a bit lower here. I would like to use a blank chart for the moment, okay? Why is it so delicate? Because let's say I take an entry here with a stop loss here. Tight stop loss. Let's say it's only, whatever, 20 pips. Let's say it's tight. And price goes my way, kind of struggles here. The longer this trade takes, the more likely that price is going to hit our stop loss if it's a very tight stop loss. It's almost like Murphy's Law. And if we have a looser stop loss, right, then we might be able to survive more consolidation. We might be able to survive price doing more random movements, more corrective movements before going our way. But if we're using a tighter one, then the chances of, if the trade lasts too long, price hitting our stop loss increases in my experience. So what we can conclude from that is that either we use wider stop losses and we can be a bit more patient in general with the trade and how long it develops at the beginning, or if we use tighter ones, then we got to be a bit more demanding in how quick it goes, and the breakout, therefore, or the general movement has to be just a bit faster. Otherwise, we run that risk. So there's that relationship between a stop loss, the size of stop loss relative size of it, and how quick that trade goes our way. And here too, yet again, if it moves within 6 candles, then it's looking good. If it takes longer, especially with a tight stop loss, if it takes longer than 6, it could be a bit of a hazard there. It could be a bit of a risk. Stop loss can become vulnerable, and something you might want to look into, might want to think about how to handle that. So there's a difficult balance there with time as well and the stop loss. And in this example, sorry about that. In this example, this is pound USD, and talked about the pound USD a couple of times throughout the whole week. In fact, one of them was a bounce at these fibs. One was a breakout above the channel, and one was again later this week bounce off the 38 and the 61.8 fib. What happened today? Now the breakout, as you can see, happened here. I took it on a 5-minute pullback, and there was a clear one. This is a 30-minute chart, so there's a clear momentum on this 30-minute chart. You got, when I took it up in here, you had clearly one, two, significant number of bullish candles, 5, 6 candles pushing that direction. So price is in a momentum as we speak. Price is pushing through a downtrend channel. So I zoom in, as I already explained earlier in the webinar, to a 5 or 15-minute chart to look for a bit of a pullback and continuation. So I got the 5-minute pullback. There were about 5, 6 candles not breaking the high on a 5-minute chart. And after about 13 candles, I think it was 15 candles, then price continued. So I entered somewhere in that zone, and price continued. We got about a 15 candle correction on a 5-minute chart, which you hardly see on this chart, unfortunately, right? And price continued and went up for about 76 pips profit. And I exited as soon as 6 candles did not break the high on a 5-minute chart. That was not the best moment because it still continued a bit higher, but okay. Actually, this is the pound yen, not the pound dollar. I thought this was the pound dollar. So that trade actually ended up for 96 pips. Sorry. I thought this was the cable. Anyhow, point is that the breakout was in a momentum, and because it was a momentum, I used a tight stop loss of, on the pound yen was 40 pips, on the pound dollar was 20 pips. Might not seem so tight, but for pound yen, it's not bad. I just used the most recent bottom on a 5-minute chart. If that trade would have lingered too long, I would have been at risk. Why? Because let's say if it takes too long and price goes like this, 5 to 6 candles on a 30-minute chart. Well, then there's a serious risk of price going up down to the 38.2 fib and then bouncing up. What happened just now? We had an impulse, a correction, a continuation. And the longer price stops here, the more likely we're getting into the break pullback continuation mode. And if I have a tight stop loss just below this candle, I'm having a stop loss in that case that's in the middle of nowhere. That is just like in no man's land. Why? Because the real bottom is here. Do I want to put a stop loss there? No, because I'm trying to catch the impulse. But if a pullback happens, I'm very vulnerable with a stop loss like that. And more secure, of course, is the second stop loss, not the first. So from that point of view, I would like to see price move fast in my way so that I know that the tight stop loss is not all too much in danger. But if it stops here too much, like this, it could be just a very small bull flag, but the bull flag, even a bull flag, could easily hit the stop loss. And I'm very much in danger. So as soon as it takes too long, gotta exit that trade and re-enter. If it doesn't correct deeper, right, re-enter upon the break, for instance, of this triangle like that, to limit the risk of the tight stop loss. Does that make sense, this part? Otherwise, I might continue repeating myself. But does that make sense, this part about the relationship, about time, and whether it continues or whether you get the pullback, and if you use a tight stop loss, that you might run into trouble if you get the correction. Because in that case, you just put this put the stop loss right up into the danger zone as this swing high, swing low closes, and you get a new swing high, swing low, and then perhaps another one. All right, cool. So trade management. Well, we talked about it already, but just I guess to one more time, it's one way of exiting. This should be exit. Momentum is finished. Lack of momentum, those kind of things are definitely a thing. And of course, price levels too. I'm not saying. I mean, if we see a lack of momentum at a strong resistance zone, could be a very good, decision to take that profit. However, if we see the momentum ending in an area where there's really not no or hardly any support or resistance, might be worth it to hang in that correction through that correction because we could get a follow through. An example of that might be, for instance, here we see momentum, we see a correction. Well, if we lived through that correction, we would have gotten another momentum in our favor. This is an example where I didn't have much patience with the trade because price just went sideways. It didn't really move out of that zone too much, and decided to take that trade. It was also a bit of account management that was also taken into account because other trades were going my way. So I thought, why take that risk on this trade? And also it was the slowest mover. So got out for 0.6 and 4, minus 4, sorry. So, that was, from an optimal point of view, I think I lost, perhaps could have stayed in that trade a bit more with more patience. But from account management point of view, we thought it was not worth it. So that's one way, sometimes you can decide about patience a bit more formatively. That's my point. Timing in waves and patterns, basically when we see patterns, bull flags, bear flags, they take a lot longer. Contracting triangles, they're all longer. They take more time. Impulse is quick. It's going to be quicker logically. ABC zigzags are quick. Reversals sometimes can speed up if they have momentum and you have a lot of double divergences, or we already had momentum prior to that on this massive time frame chart of the monthly. We got momentum here and we got another momentum here. Typically we see head and shoulders patterns, for instance. Those could take time. In wave perspectives, wave 3 is the quickest, obviously, and corrective waves, expansions like WXY are the slowest. I mean, if you look at the pound USD, this was a wave 3, and it moved fast. It was quick, big fall, because it was impulsive wave 3. Here we had a huge contracting triangle on the euro dollar. From this time perspective, at least, it was slow. Then we have some comments on timing using moving averages. When price basically gets back to the MA, and I'm using a 21 EMA high-low close, on the top chart, so when price gets back to the 21 EMA, it could be a reasonable expectation of a reasonable bouncing spot, and we might see the trend continue. So that could be the time for trend to continue. So that's one way of measuring that. Whereas if price breaks below that, right, it could be time for a reversal. Like, for instance, especially if it breaks the second time, not the first time necessarily. It could be time to make the reversal through the 21 and go back to a longer term moving average, like the one I use, which is 144. And last but not least, before I hand it over to Nanette, is the combination of time and psychology. And the fact that if we're in a long trade or if we're just in a trade, there are a lot of psychological aspects connected to time and nervousness. If we're just in a trade, some traders might be immediately nervous because we just don't have a feeling for how fast price should go our way. When should we expect it, and when should we know when it's going to be some struggle? And if we don't have any idea about it, some rough idea at least, it's probably going to cause a lot of nervousness and gives us time to mess with the trade, makes ourselves actually doubt about ourselves in the analysis. So it's just a strong psychological benefit, I think, to have a rough idea at least about the expectation, when it's okay to have patience, when it's okay actually to lose patience. So from that point of view, I think it's an important psychological part as well. And that wraps up my section there on time. And I, also would like to say that if you add multiple time frames, by the way, it could get a bit puzzling to look at this aspect on multiple time frames. So you might want to start off just by using these ideas on one time frame first. You use multiple time frames by all means, but use maybe other things and just start slowly like this. Because if you want to, maybe implement it on right away on a couple of things there, it could get a bit maybe messy because then we'll be looking at different stories of different time frames and we'll see different things going on. So I'll pass it over to Nenad and let's see. Here we go. Nenad, are you there?
Yes, thank you, Chris. Excellent presentation. And this is what Chris' specialties, timing, his own way, and hope, guys, that you have learned a lot from this presentation. I will be a little bit focused on how I do the timing, because my own way is waiting for the price to reach POC zone. So that is what I usually do, wait for the price to reach POC zone. But because I know that a lot of you have been following me and the trade suggestions, it's okay. But now let's say that you also want to learn something different from POCs. Let's say that you need to know the proper timing for your entries or exits. This is the most simplistic explanation. I have only one slide, and I was thinking that to go without any slide because I'll be focusing on charts. But the thing is that I want to tell you a few facts. The first fact is the busiest session, definitely London. So if you trade Forex market, the best timing is to trade London session. Best hours for trading are the first 3 hours of each session. And a lot of people have been asking me, what does it mean, first 3 hours of each session? So it's simply this. If you start trading during London session, that means that you're trading the first 3 hours of London session. Then we have New York session, right? So it means first 3 hours of New York session. Or if you're an Asian trader, it means first 3 hours of Asian session, not counting Wellington, New Zealand session. So we don't trade New Zealand session, guys. Okay, that session is very rarely tradable. Most of the time, the only movement you might see is New Zealand dollar news or something connected to New Zealand. So Wellington session is out of the question. Unfortunately for people who live in New Zealand, well, it's not very suitable because Wellington is not very tradable session. It's not profitable. Now, why is that so? Currency rates are hugely influenced by the demand and supply of currencies. Okay? So most of the time, when you see equity markets move, that means that also Forex market will move. Equities are connected to Forex market. So it is so-called intermarket correlation. Very rarely, equities move during New Zealand session. So you will probably see some movement during Asian session. But for European traders, Asian session is a little bit late, right? Occasionally, I follow up Asian session. I try to be there because my average sleep time is like 6 to 6.30 hours. And occasionally, I'm there to follow up with Asian session. But I'm not able, as most of European traders, same as most of European traders, I'm not able to completely follow through the Asian session because obviously we need to sleep, right? And the thing is, only during Asian session and it's approximately during the third hour of Asian session, market starts to move. That is because the equities markets are very active then, because also there are some European traders who are very early there to follow with Asian equities, and that also moves forex market. So not very often you will see that some European pairs move huge during Asian session, but more often than not you will see that Australian dollar yen, Australian dollar, New Zealand yen, those dollar yen, those markets which are correlated to equities, they're moving very fast. Now, of course, as you probably know of, the biggest correlation is between dollar yen and Nikkei market, and Australian dollar yen and ASX 200, which is Australian market, and Chinese stocks, Chinese 50. So basically, those are two good currencies you can time for good entries during Asian session. Okay, so New Zealand dollar yen, Australian dollar yen. My favorite is Australian dollar yen, or odd yen. We call it odd yen. So if you trade Asian session, your best timing is the first 3 hours of Asian session, excluding Wellington. That means the best is the third hour of Asian session, which is around 4 GMT, 4 a.m. GMT. And the best pair is Australian dollar yen. Of course, dollar yen is also good, but Australian dollar yen rules indeed. So during periods of low activity, the spreads may widen as the overall liquidity drops. You will usually, even if you trade off ECN accounts, you will usually notice spreads widening during early or late hours. It's perfectly normal. So don't be alarmed. That is perfectly normal because there is overall drop of liquidity, and because there is no good liquidity going on, liquidity providers of course are providing brokers with liquidity, you might see some spreads widening, and that will usually cease after midnight. But just before midnight, let's say around 10-15 GMT, you will see some liquidity drop. You don't trade then, because market is waiting for the news, which usually happen during Asian session or during European market next day. And that is, Mondays usually start slower as the news are just in the preparation. So that means that you should wait for news to kick in, or you can trade, let's say, early London session, or before London session, you might try to trade Frankie fake, but overall liquidity is not that high. Market moves, but it's much better to trade it during European market and New York cross overlap. So that is how I see the timing. So my timing is always preparation, analysis or prediction, and reaction. When you trade, you don't want to predict. The only thing when you want to predict is when you do the analysis. But of course, not all traders are good analysts, and neither good analysts are always good traders. So we always need to find a compromise. Luckily enough, with Camarilla MACD, I'm able to predict, of course, with my analysis of the market. I'm very good in prediction. But also I tend to react by using different kind of strategies, and in between it's POC, which is our next subject, points of confluence. Okay, Mr. Gasparci is asking Euro-Dollar DAX and S&P correlation. Definitely we will need to have other webinar for correlation, and I will schedule the webinar because now the schedule is already full, so I might schedule it in April. So I need to prepare the webinar, and it will be the full 1 hour webinar with intermarket correlations. Yes. So don't worry. Now let's see, this is the only slide I have. Now I will show you what I think, for example, about the timing. Today we had New Zealand dollar analysis. And again, guys, somehow the overall timing of the market is definitely in accordance to moment which happened just after I published the analysis. It was perfectly aligned. So first thing is I watch the markets, as I said, then I do the analysis, the reassessment or assessment of the forex pair, and I try always to watch for some cues from equities markets. And today, just after I finished with New Zealand dollar analysis, there was a huge spike in oil price. First, the oil went up, and usually it was correlated to Americans buying and playing with oil price, because usually at 12:30 GMT, New York opens up and stock market opens up, and you will see some big movements at 2:30 GMT. And that was the time when Americans kicked in, playing with oil price, and you saw a huge spike of New Zealand dollar to POC, and fortunately for us, it was rejected. So the price was here, it spiked up to POC2, and then it was strongly rejected towards 64.50, slightly below it. So hopefully, if you traded this New Zealand dollar, it was basically pretty much logical. Quick in, you see a big volatility. I also tweeted about volatility. If you follow me on Twitter, you know that I said that oil, the market is volatile, and the oil is the cause, some news with Russia cutting the production with OPEC. So that was basically, it had a huge influence on most of forex pairs. And you could see also a huge jump in New Zealand because dollar was getting dumped. And then what happened is dollar again was getting stronger, and New Zealand dollar dropped here from POC to straight towards 23.6. This retracement, and now it's in between, but it's around POC now here again. So that is what I always try to predict, POC zones with the analysis. And reaction is always reserved for pressing the trigger. So once I saw that POC is here, I pressed the trigger, sold it, and then even if I was in POC one trade, it was profitable because basically the price respected the analysis. So the thing is, you want either to predict, either to react, or both. It's called hybrid, prediction and reaction. But obviously, it's always good to react because you predict only if you are the analyst, not just a trader. Overall, that is how I see the market. So before each session, I tend to do the analysis preparation, and I watch my trigger points, which are POC zones, points of confluences. Once the price enters POC zone, I don't wait for the candle close. I'm not interested in candle close. I press the trigger, and because that is price action trading, I'm pressing the trigger and bang. It will be either target or stop loss, usually the target. One more thing with timing, and I will finish with webinar, how you can basically watch the best price movements. So guys, one more thing which should be very clear to you. The biggest liquidity and the best trading days are from Tuesday till Thursday. Don't forget it. The best trading days are Tuesday till Thursday. Okay, that is when liquidity is the highest. That is when traders prefer to trade. Most of the traders love to trade. And Friday is usually reserved for profit taking. So Tuesday till Thursday usually are the best trading days. One more trick also, you can put those vertical lines at London Open, New York Open, and end of day, and you will see that basically that is when price action makes the best of its movement. So this is Wellington and Asia session, and here we see London Open, and then you see a cross session, overlap of European session and New York, and you see how the price reacts. Now we see end of day trading, which is usually reserved for profit taking. So you can clearly see it here. If you're not sure which session you trade, then go to session map with Admiral Market Supreme Edition, open your session map, and it will show you the correct session you're currently in. You see, it's here, and it's correlated to your own time. So this is 8 time, platform time, and it's actually 7 my real time. I am within GMT +1 zone until 28th, I think, of March, when we'll move to GMT +2, and London will be GMT +1. So this is your session map. And if you're not sure which session you're in, I'm sure that you know, but just for example, you can open a session map and be sure which session you currently trade. So stay away from Wellington, Sydney. Try to exploit movements during London, during New York. If you're able, also you can trade Tokyo. Mark these lines and watch the price movements. And one more thing, and I will finish, how you can time the retracement. Simple enough. Let's say that you want to watch 1 hour hourly charts, and it's usually the best compromise between intraday and, let's say, a little of the swing trading. The thing is, when you see this, you know that market is going up. Let's see a trend. It's better to watch the trend, not range of market. So this is when market is trending. As soon as the first candle goes in opposite direction, you place your fibs. And this will be when I think the retracement has started. During strong trends, usually you will not see a big retracement. As I explained it already, the best pullbacks are here, and even there, deeper pullbacks. But 23.6 is only reserved for shallow pullbacks. What it means is that the trend is strong. Usually, when you see a trend, this means that the trend is strong, shallow pullback. Now, this is much better here because immediately when this candle closed and this candle showed the opposite side, I knew that this was time to put a retracement fib. So once you see that after a bullish market, you see a next bearish candle, immediately put, you don't know if it will be a full retracement, but then just use your retracement tool and watch. Perfect rejection from 6 to 1.8. So you see, that is when you time your retracement, how you time your retracement. It's very important because very often you will not be able to time it perfectly if you miss this first candle of a pullback. So that is, guys, what we had for you today. I hope that you enjoyed. Chris has presented you also with good stuff. Here is some tricks which I also do. So thank you for listening. One more question. Mr. Gaspacho, do you put limit orders to POC zones or watching an open market orders for pull the trigger? Very often I am going with market orders because it can happen, because it's 15 pip of a pullback, it can happen that the price reach my POC zone, and if I don't scale in, if I don't divide my trades, it can miss it for 1 or 2 pips. So I tend to go with market orders. If I go with pending orders, then I usually divide my trade. So if my trade is, let's say, 0.3, I might divide 0.10 on 3 separate trades which are in the zone. Okay, so that is how you can do it, Mr. Gaspacho. Divide your whole trade, your whole volume. Let's say you want to trade with 0.30, then you divide it to 0.10, 0.10, 0.10 within the zone, keeping stop loss the same. Okay, thank you, guys. Thank you for your comments. We will see you very soon. Thanks for your support, for voting for us, and we will talk with you very soon on Monday. Have a great weekend. Cheers and trade safe.